Hello and welcome to the Benzinga podcast. Hello and thank you for joining us on the podcast today. I want to briefly remind everyone that the easiest way to get the Benzinga podcast in the future is to subscribe to the podcast in iTunes. On the show today, we have part 2 of the conversation between Benzinga's Alex Schiff and John Burbank. John is the founder of the hedge fund Passport Capital.
Was that performance only possible because of the shorting opportunities that came around from the housing crisis and the impending recession, or is it possible to make that kind of gain in today's environment too?
Yeah, so, we made something like 90% on our longs gross in 07, so we did incredibly well on the long side, but it was really the risk was so improperly priced. To make such high returns, you need either to own things that will double, triple, I guess, which, it's hard to have a portfolio that does that without excessive volatility, of course. So if you're not going to do that, then literally you need to find risk that is completely improperly priced. It is possible, I suppose, but we're in a world now where you have a lot of people trying to find those mispriced risk, those defend against the tails, and a lot of this insurance is too expensive now. Everyone's much more aware of the risks out there, and you have a lot more partly because of the subprime profits that we and others got. There's more attention to looking for these things. It doesn't mean that things like we're short JGBs in Japan, believing that when you're close to 250% debt to GDP, that financing costs could rise enormously. But until the market rejects the JGBs, it just stays very low, and you end up with a negative carry that you have to cover. And so I'd say it's possible, but it's more possible when people can't imagine those things happening, like 07, than it is now.
Okay. Now, as a result, what do you see as the most promising investment opportunities, long or short, for the next year ahead?
Well, when you say promising, do you mean goes up the most with the least loss, or do you mean, it might go up a lot or it might not, kind of thing?
I would say that it's going to go up the most.
Well, it's a hard question because it's all about probabilities and about the chance that it does and the chance that it doesn't. So, for instance, I could say that that JGB trade, or betting against treasuries of any of the Western world, the G6. I think eventually there's going to be crisis in funding, with these relatively short-term maturities, but it doesn't mean it's going to happen in the next 12 months. In fact, I think deflation is what's in control here, because basically the buildup of debt that Greenspan enabled has created way too much capacity that demand can't fill. So you can have a view about these things, and yet I can imagine treasuries or even JGBs continuing to rise in value because people are using the liquidity and the sure return to put money there as opposed to equities and other risk assets. So the other reason not to be dogmatic is that we have no idea what the Fed is going to do. If the Fed stays on the sidelines and doesn't do anything more, I can tell you we're going to have deflation, and most risk assets are going to go down in value, certainly including equities. But if the Fed doesn't, if it does more quantitative easing, buys more assets, then, and if it keeps doing it, then the market will start doing the reverse. It'll start betting on inflation. Treasuries will come off, and we'll go down in value. So, in answering your question, it's a hard one because there are very few securities or investments that will work in both instances.
Okay. Now, in a few months, you'll be speaking at the Value Investing Congress about ideas like this. Can you give our listeners any previews of what you'll be talking about there?
Sure. Yes. There's what I'm going to talk about. I'm analyzing the government, the United States government and Congress, the way that we've analyzed many other industries and markets. I've been a very apolitical person, tried to stay away from politics, and almost everybody I know, particularly in the hedge fund money management industry, has done the same. What I find fascinating is that we've bred a group of high-powered investment and business people in this country who are really dimly aware of how Washington works, who may have biases one way or another, but who haven't spent that much time dealing with D.C. and don't have a lot of relationships there. What I find interesting is that it's allowed over the decades a very different kind of person or animal, you might say, to assume power there. And now, anyone with wealth or ambition in this country are far, far more vulnerable to decisions being made there with very little contact and familiarity about how things work. So what I'm essentially going to do is investigate how I'm going to sort of lay out how I think the situation is, what people can actually do from an investment standpoint, and look at it, and also articulate that if they don't do this, and there's a limited time, we only have a few years, I think, to really address this, then I think what I'm saying is here's where you're going to want to invest otherwise, and it's certainly not going to be in the United States. There's a whole other asset class of more economically free countries in the world where I believe capital and increasingly human capital is going to go to in the next few years. Places like Canada, Australia, Hong Kong, Singapore, that kind of thing.
And now when all these decisions that you're saying are not the proper ones by governments come to fruition and the results are beginning to be felt, I'm assuming that you think it's going to be a very very catastrophic scenario. And you've even been approached to several investors to create funds designed to deal with just that and hedge against Armageddon scenarios, if you will, like hyperinflation. Could you tell us a bit about your work with those funds and what they're comprised of?
Well, so we've analyzed, we do in our global fund, which is the fund I started 10 years ago, and we have a number of macro hedges and trades in that fund. So the basis for what we would do otherwise is the same kinds of things we do in the fund. The issue, though, is we do not want to do trades that have to be actively managed. We don't want to have a macro trade, to say be short the most simple one would be, to own puts in the S&P or something. That's not something we would offer or do because it's so easy for other people to do. But the point is, we want to put on trades much like the subprime trade, where we put it on, leave it on, for 1 year, 2 years, 3 years, and if it pays off, it pays off. If it doesn't, it doesn't. A lot of investors want to have those trades on, but they actually want them to be more actively managed. And we decided, given the range of things we do, that we are offering some of those trades in our main fund. But otherwise, if we were to do it, we'd just want someone to invest in one idea. And so we've talked to investors, either you agree with this trade or you don't, and we can basically put you in this trade, but we're not going to actively manage it. We're not going to have 5 of those trades and worry about the monthly return. So we've essentially decided between that and the fact that so many people are looking for these trades means we think the market is overdone, and so we've waited actually to do this in any greater scale than how we do it currently.
Now, where are you advising these investors to put their money to hedge against these scenarios?
Well, so there are a couple principles. Number one, liquidity is going to be a significant issue, and that one should have cash available. Second, you should not have leverage. You should have a lot less margin than you ever did before. Third, you should be diversified. You should not have all your money in one market, or one currency, for instance, or one sector, or one asset class. Even for hedge funds, you need to think like you're a Brazilian, businessman of the 1980s. You need to be ready for, massive deflation or massive inflation. You need to have a lot of your assets, have liquidity, be able to get liquidity on them so you can make choices. I think that one of the single most appealing investments as a long as well as a hedge is physical gold, and we wrote a long paper in our thesis about why you need to own physical gold as opposed to any other gold derivative in the world. So I think if I had to choose just one thing that will perform well over the next, say, 3 to 5 years that I don't worry about, it's physical gold, because I believe the demand for physical gold as a way of dealing with this, as a hedge, a way of dealing with this crisis, something that's very liquid, that's recognized around the world. It's gold, and it's not just it's not GLD, it's not gold futures. It's getting your hands on physical gold, which is what central banks around the world are doing, at least the emerging market ones, and what increasingly individuals are doing. So that would be my answer if I had only one thing. I don't think it's going to go up the most of anything, but I can tell you that if the bigger the crisis that exists, the more likely gold's going to perform inverse to that.
All right, that's very interesting. But now that we've got all these serious and hard questions out of the way, if you will, we've got a few more fun and lighthearted ones. How do you get your news on the data, on the market, and are there any particular websites you visit frequently?
Yeah, it's a good question. Of course, we use Bloomberg, which but is more a traditional news service. And that's just accessible to so many hedge funds. But other than that, really like Zero Hedge. That has a lot of sort of semi-conspiracy theory reports, many of which I believe are true. There's a wide variety of sites that are more dedicated to particular sectors or other areas. A lot of times, I get a lot of my news through research we pay for, like the King Report, or 13D, or Macro Maven, or a lot of things that are probably unfamiliar to you, but most of these cost between, say, $5,000 and $30,000 a year, which we pay for out of our research budget. But if you're going to go through just the internet, then I think you do well to the internet's a great thing. What I like though is the filter, finding someone or some service who filters stuff and then provides a concise opinion about what's going on. That's more efficient for me.